Hi, have you ever heard of seigniorage? It's a very old trick in a financial book and it's costing you money right now. To understand how money printing works now, we need to start with a short history. So we are going to skip the times when folks were using cattle, grain or even other people as money and fast forward to the moment when the first coins were invented about 600 BCE in the state of Lydia, which is modern-day Turkey. King Aleates printed the first standard state-issued coins. Imagine being the guy who could casually print the only money existing on Earth. Pretty cool, right? Little did he know that 2000 years later you could create your own fart coin with a market cap bigger than his whole kingdom. And ever since, almost every king or state who gained enough power has tried to print money. And of course, the same way crypto bros rip off people now, kings thousands of years ago rip off their peasants. They call it by a fancy old French word. La seigniorage. How it works? You mint a coin with only 10 grams of gold, stamp 20 grams on it, and if anyone is stupid enough to question it, you just chop his head off. The Romans crank it up by quietly mixing cheap copper into silver coins, while medieval rulers simply recalled old coins, melted them, and reminted thinner new ones. What's left is instant cash for wars and castles. Because only the crown could legally coin money, that hidden spread functioned as a stealth tax most people didn't notice until their money bought less bread. La seigniorage, so to say. One might think this kind of ripoff is now an ancient history. It's not. It has just been rebranded, hidden under fancy words and in a complex financial structure. And we are going to figure out how the modern version of this trick is working against us right now. The short answer you can get from internet is that money created every time a bank issue a loan. That banks don't take money from other people's accounts to lend you. They just print, or better to say, create money from virtually nothing. It's true that in its basic form, but here's so much more to it. Let's take a deeper look at why it's not that simple. So first of all, banks have a balance sheet, basically a table that states what they owe and what they have. When they lend you, let's say 10,000, it creates two entries in the table. First, the bank now owes you 10,000, and second, the bank now has an obligation to repay it back with interest. Let's say 15,000 in total. The bank rebrands your obligation to pay it back as an asset, and then 10k it owes you as a liability. If you repay your money, the bank closes the deal by removing both entries. What's left is basically the bank's profit. So what happened? The bank created money from thin air, lent it to you, and then made a buck of it. It looks, and it is of course a very easy thing to abuse. That's why there are so many rules by the government and the central bank about how, to whom, and under which conditions bank can lend. Otherwise it would be a money-printing cheat code, right? Not necessarily. Let's have a look at what happens if instead of spending 10k on a productive means, you decided to blow it on a fart coin and go broke. The entry showing that the bank owes you still persists because the money the bank gave you is spent, but the asset part of the shit is gone. Now the bank has a 10k hole on its balance. Another important question to ask in this situation is, why does this bank care about its balance sheet? At the end of the day, it just owes the money it created itself a moment ago, right? To answer that, we need to introduce a new player, the big and powerful central bank. And with the introduction of the central bank, I also need to explain an important concept about money. Not every dollar is created equal. Actually, there are three types of money: bank money, cash, and central bank reserves. The last two are what you can call real money. Cash is obvious, but what are reserves? Reserves are essentially digital cash. The weird thing about it is that you can hold reserves directly. Why? God knows why. Okay, actually I know too, but that would take another whole video to explain. The point is, only banks can have central bank reserve money. Keep in mind that all three forms of money are denominated in dollars and are interchangeable one to one in one way or another. That's why they're all called dollars. But what then is bank money? Well, it's money created by banks expanding their balance sheet and backed by the assets they hold. So when you bring your precious cash to the bank, they created a deposit for you by issuing 10,000 of bank money to your account. Your cash is converted into central bank reserve money and sits in the bank backing your account. When you wire this 10,000 to your dad so he can buy a beer, your bank sends 10k of central bank reserves to your dad's bank, and the dad's bank receive it, means 10k of bank money and puts it into your dad's account. So why, for such a simple operation, do you need two types of money? Actually, you don't. You need it for loans. Banks can't create central bank reserve money, but they can create bank money. When we were discussing lending in the bank's balance sheet, we were talking about bank money. Coming back to our example of not paying the 10k back, leaving the bank with a 10k liability on its balance sheet, ask again, why does the bank care about its balance sheet? And the answer is, it cares because when you spend your loan, your bank has to move the central bank reserves to the bank of the person you paid. If the bank fails to do so, the transaction can be settled by law and the bank become insolvent. In an imaginary world where the amount of central bank reserves is constant, banks can create only as much bank money as the risk of insolvency will allow them. The more bank money you create without obtaining more reserves, the more claims you will have on your fixed pool of reserves to settle the transactions. In this system, banks create money by lending it to healthy businesses so they can earn even more and repay the loan. It regulates the money supply to productive users, which expands economic output and deters banks from bad loans out of the fear of insolvency. Pretty good system, isn't it? Kind of. One can still say that banks have the money cheat code, but it has its limit. What happens when it breaks the system? Hold on and I will explain why. The main constraint in this system for bank is insolvency, but if your bank grows and becomes really big, the rules change. Your insolvency is no longer only your problem, it's everybody's problem. So what happens? The government bails your bank out with taxpayer money, either directly or indirectly by the central bank printing money to save it. Point is that you are no longer afraid of lending. Neither you as CEO nor the shareholders of the bank care about whom they lend. The more the better. While it works and loans are repaid, banks issue dividends to shareholders. When it fails, no problem, you receive a bailout from the government, catch a little bit of bad press and that's it. The problem with the banks creating money isn't that they create it from thin air, but that when they landed badly and should go bust, they've got saved by taxpayers and continue operating. In that case, it doesn't expand economic output, it just creates inflation and sucks money from the government and taxpayers. But what if the punishment for reckless lending was even more money? Let's expose this twisted logic. Remember our example of a perfect world where a bank's ability to lend is bounded by the fear of insolvency because it can run short of central bank reserve to settle transactions? Well, in the real world, a bank can just borrow from the central bank. Yep, short on cash, just borrow from the central bank. Of course, there are some rules and regulations, but in general, you can expand your bank reserves as much as you want by borrowing from the central bank. You just need to look solvent. Your numbers have to look good. See the conflict of interest. You can make bad loans as long as you can show the central bank that your numbers are good, which creates a huge initiative to cheat. Unsecured loans to zombie companies? Easy. Or take 2008 crisis, for example, all the rating agencies, Moody's and etc. gave high scores to financial junk. Why? Because banks could lend money to buy it, show the central bank that they had very good, very safe assets with high credit score and just ask for more money from the central bank. When the scheme crashed, well, see the previous point, government bailout. No consequence whatsoever. Government bailouts make banks fearless. But wait until you hear about the central bank's ultimate trick, QE. And now finally, QE, the final boss. Remember those garbage financial securities backed by mortgages handed out to literally everyone who just show up at the bank? The Fed just bought them. Bank had bad assets? No problem, the central bank bought them as well. See what just happened? Banks swapped the garbage assets they created for central bank reserves. And what can they do with that huge boost in reserves? Right, lend even more, hopefully to better borrowers. But even if the new loans are good, it still means banks created money backed by pure garbage and then swapped that trash for cash, which they can now lend to better borrowers. No need to advertise for deposits. No need to go into debt to the central bank. Just lend money to a broke guy and swap the unpayable loan for liquid cash. Easy money. It's wrong on so many levels, especially on the moral one. It represents a huge wealth transfer from the productive part of the economy to the unproductive part. And by doing that, banks were rewarded with an increased balance sheet and more capital on hand. And by definition, the unproductive part of the economy consumes more resources than it generates. In a world of finite resources, an increased money supply directed into bad loans and unproductive sectors means it all gets paid by ordinary folks like you and me. This hidden tax can take many different forms: high inflation, assets bubbles, tax increases, unemployment, wage suppression, and etc. The passes can be different and sometimes very complex, hidden under sophisticated words, but the core remained the same through the centuries. Le seigniorage, baby. And that's it. Thanks for watching. Feel free to hate me in the comments, like and subscribe to my channel, and see you in the next one.